In the world of finance, a huge shift is happening. We're moving away from old school gut instinct and diving headfirst into the age of the algorithm. This is completely rewriting the rules of stock trading, not just for Wall Street pros, but for everyday investors like us. So in this explainer, we're going to break down what this all means for you.
Think about it. We've all felt that little voice in our head, that gut feeling telling us to jump on a hot stock or to panic sell when the market takes a nosedive. But seriously, in a world that moves at lightning speed, is our intuition still our best guide, or has it actually become our biggest liability? That one question is at the heart of this entire revolution.
Okay, so before we can really appreciate all these new tools, we've got to look at the old way of doing things. It's important to understand the flaws, right? Let's start by breaking down the built-in limits we all face as human traders.
So right here, you see this fundamental clash. It's like two different philosophies going head-to-head. On one side, you've got human judgment. It's creative, it's flexible, and it can understand subtle things like market buzz. On the other side, you've got pure algorithmic logic. It's all about speed, data, and executing a preset plan with total, ice-cold consistency.
And these are the exact things that can trip us up. First, our emotional biases, fear and greed. They can make us do the exact opposite of what we should, like buying high and selling low. Then there's information latency. By the time you read an article and decide to make a move, the big opportunity is probably already gone. And our cognitive limits? Come on, no human brain can process thousands of data points at once in real time. When you add it all up, it puts us at a real disadvantage in today's markets.
Okay, so with all these human limits laid bare, the market was basically screaming for a new player to enter the game. And that's where the algorithm comes in, a tool designed from the ground up to beat our weaknesses in this high-speed financial world.
So what is algorithmic trading, really? Well, at its most basic level, it's just using a computer program to place your trades for you. You set the rules, the strategy for when to buy, how much to buy, and what price to buy at, and the algorithm follows those rules perfectly, with incredible speed and zero hesitation.
And believe me, this isn't just some tiny niche corner of the market. We're talking about a market that's projected to be worth almost $24 billion by 2029. It is a massive and rapidly growing force that, get this, is already responsible for more than half of all trading in developed markets.
This is where AI just takes things to a whole new level. It boils down to three simple but incredibly powerful steps. First, it just inhales mind-boggling amounts of data, way more than any person or team ever could. Second, it uses machine learning to spot these tiny hidden patterns that are completely invisible to the human eye. And finally, it executes the trades instantly, in nanoseconds, to actually capitalize on those patterns before they disappear.
But, and this is a big but, all of this incredible power is a total double-edged sword. With the potential for these huge rewards comes the risk of equally spectacular failures. So let's look at two real-world examples that perfectly show both sides of this coin.
Okay, for the upside, you don't have to look any further than Renaissance Technologies' Medallion Fund. It's one of the most secretive and, frankly, successful hedge funds in history. It uses these super complex mathematical models to trade. And the result? It's almost unbelievable. A 66% average annual return since 1988. It is the absolute gold standard for what algorithms can do. But then, there's the other side of the coin. Back in 2012, a huge trading firm called Knight Capital rolled out a new piece of trading software. A tiny bug in the code basically caused this algorithm to go completely haywire, flooding the market with crazy random orders and pushing the entire company right to the edge of collapse. So just how bad was it? The firm lost $440 million. We're not talking about a year or even a month. We're talking about 45 minutes. It's just a terrifying reminder of the speed and the scale at which these automated systems can fail if they're not managed perfectly. All right, so after seeing that incredible potential and those terrifying risks, the big question is, what does this mean for a regular investor like you or me? How can we even begin to approach this world? Let's break it down into a simple, practical starter kit. So, most strategies really boil down to a couple of core ideas. Here are two of the most popular. Trend following is exactly what it sounds like. It's about riding the wave. Your algorithm buys into things that are already going up and sells things that are going down. Now, mean reversion is kind of the opposite philosophy. It bets that a price will eventually snap back to its long-term average. It's all about buying the dip and selling the peak. The great news is, you don't need a PhD in computer science to get started anymore. There are now platforms for pretty much every skill level. If you want to test out your ideas, TradeStation is famous for its backtesting tools, which let you see how a strategy would have done in the past. If you don't want to code at all, Trade Ideas uses AI to find opportunities for you. And if you do want to code, something like QuantConnect gives you an open-source sandbox to build from the ground up.
So, after looking at the flaws of human judgment and the sheer power of these algorithms, where does that leave us? Is the future of trading just handing everything over to the machines? Well, the real answer is a bit more nuanced than that.
You know, there's a key insight from the research on this that really nails it. It says that this whole debate over humans versus machines is a false choice. The real path forward isn't choosing one over the other. It's about finding a smart way for them to work together.
So the best strategy, the real sweet spot, is a hybrid approach. It's about using algorithms for what they do best, executing trades with incredible speed, analyzing huge amounts of data, and following rules without any emotion. But you keep human judgment in the driver's seat for the big picture strategy and for those qualitative decisions that machines just can't make yet.
Look, this shift from gut instinct to algorithm isn't just some passing trend. It is a fundamental change in how we interact with the market. It gives us these incredible new tools, but it also demands a new level of understanding from us. So the final question really comes back to you. How will you upgrade your investing strategy?